tomorrow is NFP, and NFP is known for bringing huge volatility, particularly in the foreign exchange markets. But tomorrow, all eyes will be on stocks because the only thing holding this economy together is a tight labor market. And with ADP numbers and initial jobless claims looking soft, should we expect soft numbers tomorrow or something else? Today, we're going to dive into the expectations for NFP as well as the S&P 500 ahead of tomorrow's massive number. However, today's volatility was brought to you by Nvidia. The Justice Department is investigating Nvidia for monopolistic practices in regards to AI. So we have to answer the question today, could this be the straw that breaks the camel's back? We're going to talk about that and also seasonality for the S&P 500, the 10-year yield, as well as the Dow Jones. The probabilities of what might happen will actually truly surprise you. And we're also going to discuss liquidity, the global economy, as central banks begin to cut rates, and of course, sentiment. Price often follows sentiment, and I'll show you where we stand with sentiment today. As we continue to make new all-time highs in the S&P 500, what comes next, and should we be concerned? Join us today as we discuss that and everything else. We've got a lot to talk about, so let's roll the tape. Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. Now, this is the S&P 500 daily heat map. Actually, a very mixed day across the board today. I mean, the big boys in technology, semiconductors, Apple, they just didn't put out the day, and that did affect the overall technology space. Nvidia at one point was down 5% on some antitrust news. The Justice Department's going to launch an investigation into them on some of their anti-competitive behaviors. Nvidia piled a lot of the losses, but still down big for the day, and the rest of semiconductors did follow Nvidia as well. But it didn't affect all of tech. Infrastructure technology put out a fairly alright day, and same here with software on the back of Salesforce and Uber. Some of the big boys did gain today. Google, Amazon, Tesla, Berkshire, Costco, Eli Lilly. These guys did put out fairly big days, and they did support their sector overall. We saw the consumer do really well today though. Look at stuff like restaurants, right? And look at stuff like staples. That's actually a very positive day in the broad context when we had stuff like industrials and tech not do that great. Industrials really took it on the chin today, and so too did asset management here in financials. But there were some winners in financials: Visa, MasterCard in credit services, as well as PayPal, up 5.49%. And there's a bunch of rumors circulating, the most recent of which is that Bill Ackman may actually be a buyer of PayPal at this price, as we spoke about it in the live stream. So if you guys want to join the live streams, check it out every single day, pre-market open, and on the weekends we're always normally live. But other than that, it was a very mixed day across the board. There were winners, there were losers. Such goes the market. But the biggest winner today was definitely GDX and XME, and it had to do with the ECB. They cut rates by 25 basis points. Whenever easier monetary policy is going to get involved, commodities are going to win because they are a currency hedge. But then we saw the consumer names: XLY, XLP, 0.52, 0.31%, and then healthcare and technology up there as well. XLE is actually a commodity driven sector, and that's why it was up there as well after the ECB cut its rate, along with Canada cutting its policy rate. So G7 countries are starting to cut rates, and a lot of these stocks in America that have international exposure to these countries are definitely going to feel the impact of those rate cuts. But if you actually look at the SPY, there was only 6 sectors that underperformed the SPY, and they were mostly the big names: financials, technology, semiconductors. Other than that, almost every other sector beat the SPY. So if you weren't in like technology, you probably had a good day in your portfolio. I mean, XLC just outperforming the SPY. Same here with materials. XLRE and KRE, real estate and regional banks, put out a very good day. You think when rate cuts are involved, they'd have a much bigger day, but we'll see how the rest of the week pans out. But all in all, a mixed day for the market, mostly driven by ECB rate cuts. We did get data that was a tad bit weak. Jobless claims missed, continuing claims missed, but all in all, it was a very mixed day of data, and most of it did come in line. I don't think it had any real effect on the market, but let's hop on the charts and I'll show you what really did move the market today. Now, the biggest market mover today was definitely the 10-year yield. You could see we had 5 very solid red days, and then we had this green day. And though we do have a big wick in the early morning trade of the S&P 500, the 10-year yield was at this high. As the day progressed, yields did fall, but that did affect overall sentiment in the market, because if we actually pull up the S&P 500, 500, head to the 5-minute chart here today, you can see, yes, we did gap up, but the initial spike in yield saw us move lower below the day's open, and we put in a low here at the 53.40, 53.42, 53.36 level, where we actually found a bottom. And then as yields moved lower on the day, we actually moved up higher and pretty much closed at the open for the day. The S&P 500 was actually down 0.02% here today. Same with the Nasdaq, pretty much flat. The IWM took it on the chin, down 0.72%, but up in the after hours. And then the RSP down 0.19% for the most part. Mid caps down as well, SP 600s. But this is coming off yesterday where the S&P 500 was up 1.18%, the Nasdaq was up 2%. So again, just a bit of digestion happening here. That tends to happen at all-time highs. The market can't just go up in a straight line, even with easier monetary policy. We do need a bit of digestion, and that's probably what we're going to see. So if you do see a little bit of sideways action into the end of the weekend as we wait for these NFP numbers, that's completely okay. It's actually kind of healthy for the market to digest gains ahead of key data. Now, we do know that yields rose early in the session, came down, still finished green on the day, but I do think that we are going to go lower, and I do expect to see about a 4.1% yield in the next maybe 6 to 8 weeks. Let's look at commodities. What did they do? Gold actually was up 0.89%, and again, commodities are going to rally when easier monetary policy is involved, when rate cuts are involved, because commodities are simply a currency hedge, and it does look like we're actually forming higher lows here in gold. So we put in a higher low, and now a higher low ahead of this base. We are breaking out above this base, and again, with highs, all-time highs, we can actually go ahead and break this high. This literally looks like a trend continuation, and I do see 2,500 and above in gold very, very soon. We saw a very similar situation here in silver. I think it tricked a lot of traders because we actually put in a lower low, but we are breaking above some of these key levels right here. But ultimately, we want to go break this high here for silver. But let's be honest, the silver chart looks very, very constructive, and ideally, unless this low is broken, this is still a very strong chart for silver. The dollar did lose here today. We found a bit of support in the last couple of days, but you know, simple price action, lower highs, lower lows, and I do think we probably move lower, especially as rate cuts continue to materialize in most G7 countries. And then looking at crude again gained 2%. That's why energy stocks were actually really upbeat today. XLE was up 0.52%, one of the best performing sectors along with GDX. But looking at the S&P 500, what can we expect tomorrow? Well, we all should be long from the 5240, 5250 area. The gamma flip zone is now at this 5270 area right here. So this is when we flip into negative gamma, but there is a lot of support here at the 5250, 5240, and then 5200. So even if we do get below this gamma flip zone, do expect to find very quick support. And when I say quick, because dealers do buy with the trend, we can actually move into these levels. Again, that's if we do break the 5270 and then bounce very, very quickly to the upside, exactly like we saw right here. You know, we got into this negative gamma environment, and then in one single day, we made a low, made a high on this green candle right here, and then continued the rally to all-time high. So that's what you get in negative gamma, whereas in positive gamma, you kind of get this type of trade. You buy dips, sell rips, but we are at all-time highs. If we do pull back to this gamma flip zone, this is where I want to find support and look for trend continuation, new highs. But a lot is going to be dependent on the NFP numbers next week. If you do want to short from here, you're hoping that the NFP numbers come in hot. I think they're probably going to come in line. I think about 185, 180K is probably what we'll see tomorrow, but I don't have any trades. I'm not going to place any bets ahead of tomorrow. We should all already be long from here. I said you want to take longs at 5200, 5250. I also said we're going to be taking longs at the 5000 level right here. So all we're doing, guys, is just holding, and we're looking for the 5400 level into June OPEX. And we still have a long runway. June OPEX is only 2 Fridays away. It's a longer OPEX month here, so no reason to get worried. Just sit through the volatility, guys. Higher highs are coming. Looking at the II sentiment survey, not major changes, but some glaring things we need to talk about, and this just goes to show the sentiment we've seen over the last week. I mean, yesterday we got new all-time closing highs, but prior to yesterday, price action was pretty stagnant. You know, we were trading in a pretty brutal range for the better part of 5 to 10 trading days. So we actually saw neutral sentiment votes at 34.2% move to 29%, and all of these neutral votes actually went on the bearish side, simply because those that were bullish at 39% stayed the exact same on a week-to-week sequential basis. What does this tell us? In the last week, more people actually became bearish under the hood, despite what price action was telling us. At the same time, when we look at the NAM exposure number, and this is essentially US fund managers' exposure to US equities, it's sitting at about the 64% mark, and we've seen a massive drop drop off from the 90% mark here in the last week. And this is pretty much telling us that despite what's going on overall, sentiment is slightly more bearish than usual, and US fund managers are actually selling equities. But we kind of already knew this, and US fund managers were actually selling technology and healthcare stocks in the past week. In fact, kind of crazy stats when you look at it. Technology saw the second largest weekly outflows in BOFA's data history since 2008. Technology was being sold, healthcare was being sold, but what were fund managers buying? They were buying comm services, consumer discretionary, financials, and energy, and for good reason. Energy, comm services, and financials have actually seen the biggest sector level change in the second quarter 2024 earnings per share. These are essentially up revisions in earnings. We've seen financials up 1.3%, mostly driven by JP Morgan Chase, same with comm services, Google and Meta, and then energy plus 6.2%. And then we also saw consumer discretionary in line with financials at 1.3%. So the sectors that were bought last week were essentially the sectors which had the biggest upward EPS revisions. A lot of the writing was actually on the wall. This was a note I put on Twitter, and go ahead and follow me on my Twitter right here, guys. I do a lot of these. And essentially what we saw was a lot of people were moving out of tech into financials, and this was just, again, some of the writing we saw on the wall. Paul Tudor Jones of Tudor Investments sold 78% of his Nvidia position and bought 888,000 shares of PayPal at $64, about 57 million. Jim Simmons, Renaissance Technology, may he rest in peace, sold 2/3 of their stake in Nvidia. They bought 2.1 million PayPal shares at $64 also. A ton of PayPal insiders were buying too in this image right here. So, we are actually seeing a rotation out of technology, again, mostly from Nvidia because they've made a ton of gains, but we've seen a rotation out of technology into financials. And I do expect this to continue, especially if we do continue to see up revisions in stuff like financials, energy, discretionary, comm services, and then the opposite in stuff like industrial staples, healthcare, utilities. So GDP now is something we've been looking at for a while because it's been on quite the downtrend, been a bit of a dumpster fire, sitting at 1.8%. Just a couple of months ago, we were here in the 4% range. What we haven't talked about is why this has happened. And the reason being actually has to do with two particular components of the GDP now. It has to do with residential investment right here. It's actually detracting from the overall number by 0.18 points, and then net exports by 0.54 points. Other than that, we look at stuff like consumer spending, very healthy. Non-residential fixed investment, 0.45%, very healthy as well. Private inventories, healthy. Government spending, healthy. And that contributes to a total of 1.8% in the GDP now forecast. Now, can net exports and residential investment increase? For sure. We just have to wait and see. That being said, that is the current number. Looking a little weak. We normally want GDP anywhere from 2 to 3%, especially in a higher inflation environment. But this is the numbers we got right now, and we have to contend with them. And with weaker GDP data comes overall weaker economic strength. The economic surprise index, ever since the start of 2024, again, like the GDP now, has been quite a dumpster fire. And that has actually been a good thing, because at the start of 2024, we saw quite upbeat economic data. People were saying the data is getting a bit too hot. But now that we're actually into deep negative data point surprises, up to 1 standard deviation right here, we do want to see this pull back to about the 0 level. If the data does come in line with analyst expectation, that is about the equilibrium we want, and we are starting to see that recently, especially with yesterday's PMI numbers, and hopefully this can continue upward to the 0 line. And with these negative data surprises has actually come rate cut expectations. We can see now that the first 25 basis point rate cut is fully priced in here for November. Fed swaps are pricing it in for the November FOMC, and we've actually seen a dovish repricing across Fed dated OISs, which is option spreads. Just 3 weeks ago, we were actually looking at 0 rate cuts for 2024. Now we're looking at the first one in November, and if this actually gets moved up into September, I wouldn't be surprised either. That being said, US economic growth is slowing. We all know that, but global growth is actually accelerating, and this is a healthy deviation from trend. We are actually going to read this article here from JP Morgan, and they talk about global growth as a whole. Growth rate of the global economy accelerates to the fastest in a year during May. Rate of global economic growth hit a 12-month high in May as new work intakes strengthened. The upturns in business activity and new orders also showed improved breadth, with all 6 of the subsectors covered by the survey registering expansion in both. The JP Morgan Global Composite PMI output index produced by JP Morgan and S&P Global in association with ISM and IFPSM rose for the 7th successive month to post 53.7 in May, up from 52.4 in April, and its highest level since May 2023. So we've seen an acceleration here in growth. Growth of service sector business activity accelerated to a 12-month high in May. Moreover, the Global Services Business Activity Index posted its manufacturing equivalent for the 17th month in a row. That said, the trend in manufacturing production also strengthened, with growth hitting a near 2.5-year high, and we also saw that with the PMIs we got in yesterday's data. Almost all of the nations for which combined manufacturing and services PMI data are calculated registered growth for economic activity in May. The only exception was France, which saw activity fall back into contraction following April's expansion. The fastest rate of output growth was again seen in India, which remained at the top of the global PMI growth table for the 23rd successive month. Rates of expansion improved in the US, Euro area, and Japan. May data signaled an increase in total new business for the 7th successive month, with growth strengthening to its highest in a year. The breadth of the upturn in new orders was also positive, with all of the nations covered seeing growth and increase in each of the 6 global sub-industries, and those are the industries. Part of the expansion in new businesses reflect a recent revival in global trade goods and services. The level of new export businesses rose for the 2nd successive month, although the rate of growth was unchanged from April's modest pace. It remained one of the best registered over the past 3 years. New export work rose in both manufacturing and services sector. Companies responded to the recent rebound in operating conditions by raising employment during May. Staffing levels increased following a negligible decline in the prior survey month and have risen through much of the last 4 years. Job growth was seen in the Euro area, China, Japan, and India, among others. The US registered broadly stable employment as cuts in the service sector offset continued growth in manufacturers. Improved current conditions led to higher business confidence during May as positive sentiment picked up after falling to a 4th-year low in April. Developed nations remained on average more optimistic about the year ahead outlook than emerging markets. May saw rates of increase in both input costs and output charges tick higher. Inflation signaled for both price measures and was stronger in the global service sector compared to manufacturing. The JP Morgan Global Services PMI Business Activity Index rose to a 12-month high of 54.1 in May. Stronger output growth was underpinned by rising intakes of new work and efforts to clear outstanding businesses, and was supported by renewed job growth. Input prices and output charge inflation were both unchanged compared to April. So all in all, very positive stuff across the board in the global market. Long story short, all measures of growth from employment to manufacturing to services are all rising, and that's going to support the broader economy. The US led, now the rest of the world is following. All right, looking at Gamma, guys, nothing has really changed from yesterday. The only thing we're seeing on a day-to-day basis is this Gamma flip zone, the 5270 area, is really just moving up. You know, about 4 or 5 days ago, this was at the 5235 area. It's now at the 5270 area. Often that's a bullish sign. That probably means a lot of this like smaller positive gamma is moving a little bit up the tape, and same here with the negative gamma. As a result, the gamma flip moves higher. Now, a lot of you have been asking me, what is the gamma flip zone? So the gamma flip zone is where we go from positive gamma into negative gamma and vice versa. Above, we're in positive gamma. Below, we're in negative gamma. Positive gamma is where dealers buy rips, sell dips. Essentially, dealers hedge by buying into weakness and selling into strength. That compresses volatility, whereas they sell into weakness and buy into strength in a negative gamma environment, and that creates volatility. So we are in positive gamma. How do we know? You can actually see the spot price right here, which was at the start of today's open, is actually above the gamma flip zone right there. Generally speaking, what we do above positive gamma is look to the call resistance as our main target, 5400, and below negative gamma, they put support being this right here, 5200. You take into consideration that these levels, all of these levels, also act as strong support and resistance. In fact, the biggest support and resistance levels. Go ahead and have a look at what last week's positive gamma was. It was 5250. That's exactly where we bounced, as well as at the 5200 level, and then we went and made new all-time highs yesterday. And in a positive gamma environment, you want to buy dips, sell rips, and look to the core gamma resistance. That's the 5400, and that's exactly what we're going to do into the June OPEX until we actually tangibly break the 5270 level and the 5200 level and move below there. Until that actually happens, we're buyers of dips, sellers of rips. This is the Dow Jones 4-year presidential cycle. So we got the election year right here. So pretty much year number 1, the first year presidential year, second and third. This is year 2, year 3, year 4. And this is where we are right now. And this is the period where we are in this cycle. And you can actually see normally during the election year for the Dow Jones, we do tend to trend sideways and we actually find a peak, pull back quite significantly. And this tends to be the low for what is a good rally pretty much from the election year into the second presidential year. There is a bit of volatility on the way, but we do make higher highs, higher lows. And then from there, we do actually trend sideways where we form another low and then rally into the third presidential year. So what we need to be looking for in the Dow Jones is possibly a low right here, a bounce off these lows. If we then go break the highs we made in the Dow Jones, let's say those highs that we made in March, April, around there, that could possibly be the signal that we've put in the bottom and we could be in for a very strong rally in the Dow Jones, at least according to seasonality. Seasonality is not a crystal ball, but it allows us to assess probabilities of what might happen. And based on history, Dow Jones should see a pretty significant rally over the next 12 to 18 months. Now, looking at seasonality for the US 10-year bond yield, this is something I've been looking at a lot lately. And normally speaking, we actually see yields rise pretty much from January here all the way into May. We normally find a peak, and like we have seen a pullback in yields, we normally see the pullback in yields be quite a significant downtrend all the way into the November, December area. I do believe that we've actually seen the top in yields for the year, especially with rate cuts on the table. We should see yields come down as a result. Now, looking at global liquidity, especially with the rate cuts coming on the table, global liquidity conditions have improved significantly. Look at United States, we're actually in excess liquidity, this turbo bid mode. The Eurozone is just into this turbo bid zone, pretty much in between bid and turbo bid at that line right there. So liquidity conditions are favorable for more upside. And that's why we've seen quite a bit of support here in the market, making new all-time highs yesterday, simply because, there's liquidity in the market. And this is actually set to continue, especially as we get rate cuts and easier monetary policy. And just capping off the video here with tomorrow's non-farm payroll print, guys. So we're going to look at the consensus expectations. Now, quickly, we are expecting a 200,000K gain in employment. The consensus is 185, but take this with a grain of salt because Goldman's expectation is 160. So BofA expect 200, Goldman expect 160. I fear the truth is going to be somewhere in the middle. Private payrolls at 170,000, the unemployment rate to stay at 3.9%, average hourly earnings month over month at 0.3%, and then average weekly hours at 34.3. That's what we're expecting. If the numbers come in above or below this, it would be considered hot or cold. Pick your poison and then go from there. And ahead of NFP tomorrow, this is the implied move for the S&P 500. We're looking at either a gain or fall of 0.95% either way, depending on if the data is hot, cold, or in line. So do be prepared for volatility tomorrow ahead of NFP. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.